Preparing for a financial analyst at Sony interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to become a financial analyst at Sony? Sony appeals to me because it combines world-class intellectual property with several business models, from PlayStation subscriptions to music royalties and image sensors. That variety would make the analysis both challenging and commercially meaningful. I would bring strong Excel, financial modeling, and communication skills, while developing a deeper understanding of how management allocates capital across segments. I am especially motivated by turning operating data into recommendations that improve investment decisions, forecasting accuracy, and long-term shareholder value. While answering, connect Sony's entertainment, gaming, electronics, and financial services businesses to your interests, explain why analysis matters in a diversified group, and provide evidence of relevant technical and commercial skills. Question 2. What do you know about Sony's main business segments? Sony is a diversified technology and entertainment group. Its major activities include game and network services, music, pictures, entertainment technology, imaging and sensing solutions, and financial services. Each has different economics. Games depend on hardware, software, and network engagement. Music and pictures monetize intellectual property. Sensors are linked to semiconductor demand, and financial services depend on assets, liabilities, and regulation. An analyst must therefore avoid applying one margin or growth assumption uniformly across the portfolio. Make sure to cover Sony's entertainment, gaming and network services, music, pictures, imaging and sensing, electronics, and financial services activities, emphasizing differing revenue drivers, margins, capital intensity, and cyclicality. Question 3. How would you evaluate Sony's financial performance? I would begin with consolidated revenue, operating income, operating margin, and operating cash flow, then disaggregate results by segment. For each business, I would compare actual performance with budget, prior year, guidance, and market expectations. I would investigate volume, price, mix, foreign exchange, and one-off items before drawing conclusions. Finally, I would assess free cash flow, returns on invested capital, balance sheet strength, and whether management's capital allocation supports sustainable growth. In your answer, discuss revenue growth, operating income, margins, cash flow, segment contribution, guidance versus actuals, capital allocation, currency effects, and comparison with historical trends and relevant competitors. Question 4. Which KPIs would you monitor for Sony's gaming business? For gaming, I would track console shipments, software units, digital sales mix, monthly active users, network subscribers, engagement, and average revenue per user. I would also monitor first-party versus third-party content, gross margin, development spending, and inventory. A key accounting point is that bookings or downloads do not always equal immediate revenue because online services and subscriptions may be recognized over time. Together, these measures show both current monetization and the durability of the ecosystem. Be sure to mention hardware units, software sales, monthly active users, network subscribers, digital mix, engagement, average revenue, gross margin, content costs, and the distinction between bookings and recognized revenue. Question 5. How would you forecast revenue for one of Sony's segments? I would build the forecast from operating drivers rather than applying a simple growth rate. For gaming, that could mean hardware units, software attach rates, digital spending, and subscription revenue. For sensors, I might use customer volumes, content per device, utilization, and pricing. I would incorporate seasonality, product launches, industry data, management guidance, and currency assumptions. Then I would compare the model with historical relationships and run sensitivities for volume, price, timing, and foreign exchange. Focus on driver-based forecasting, segment-specific assumptions, historical seasonality, product launches, market growth, price and volume, foreign exchange, management guidance, and sensitivity analysis around uncertain assumptions. Question 6. Walk me through how the three financial statements connect. The income statement produces net income, which flows into retained earnings on the balance sheet and begins the cash flow statement. The cash flow statement adjusts net income for non-cash items and working capital movements, then adds investing and financing activity to calculate ending cash. That ending cash becomes the balance sheet cash balance. Balance sheet changes also explain cash movements, so I always check that the statements reconcile and that the forecast reflects consistent operating assumptions. Make sure to explain how net income flows into retained earnings and cash flow, how non-cash items and working capital affect operating cash flow, and how ending cash links the cash flow statement to the balance sheet. Question 7. How do you calculate free cash flow, and why is it important? Unlevered free cash flow is commonly calculated as EBIT after tax, plus depreciation and other non-cash charges, minus capital expenditures and increases in net working capital. It measures cash available to all capital providers before financing decisions. For Sony, I would interpret it by segment because games, sensors, and financial services have different investment needs. Strong accounting earnings are less persuasive if cash conversion is weak, so I would investigate working capital, content investment, and capital intensity. Discuss operating cash flow or NOPAT-based free cash flow, capital expenditures, working capital, taxes, acquisitions where relevant, and why cash generation supports valuation, debt repayment, dividends, and reinvestment. Question 8. How would you build a DCF valuation for Sony? I would forecast revenue, margins, taxes, working capital, and capital expenditure separately for Sony's major segments, then calculate consolidated unlevered free cash flow. I would discount those cash flows using a risk-adjusted WACC and estimate terminal value through a perpetuity growth or exit multiple approach. After subtracting net debt and other claims, I would derive equity value per share. I would stress test growth, margins, WACC, and terminal assumptions, then compare the result with market multiples. In your answer, cover segment forecasts, unlevered free cash flow, WACC, terminal value, net debt and other claims, sensitivity analysis, cross-checks, and the importance of avoiding unsupported long-term assumptions. Question 9. How would you estimate Sony's WACC? I would calculate the cost of equity using the risk-free rate, Sony's beta, and an appropriate equity risk premium, considering its international exposure. I would estimate the pre-tax cost of debt from market yields or comparable borrowing costs, adjust for the tax rate, and weight debt and equity using market values. Because Sony spans different industries, I would consider whether a single beta adequately reflects risk and test the valuation under alternative WACC assumptions. Be sure to mention cost of equity using CAPM, after-tax cost of debt, market value capital weights, country and segment risk, beta selection, and sensitivity to assumptions. Question 10. What valuation multiples would you use for Sony, and how would you choose peers? I would use P/E for profitable, mature businesses and EV/EBITDA when comparing operating performance across capital structures. EV sales can help with lower margin or growth businesses, while price to book may be informative for financial services. Sony's diversified mix makes direct peer comparison imperfect, so I would select operating peers by segment and consider a sum of the parts valuation. I would adjust my interpretation for growth, margins, cyclicality, accounting policies, and intellectual property ownership. Focus on EV, EBITDA, P/E, EV, sales, price to book where relevant, peer business mix, growth, margins, accounting differences, conglomerate complexity, and the need to use segment or sum of the parts analysis. Question 11. How do foreign exchange movements affect Sony's results? Sony earns revenue and incurs costs in multiple currencies, so exchange rates affect both reported results and competitiveness. Translation exposure arises when overseas subsidiaries are converted into the reporting currency, while transaction exposure affects specific foreign currency cash flows. I would separate constant currency operating performance from translation effects, then examine hedging and the location of costs. A weaker yen may boost translated overseas earnings, but the benefit can be offset when imported costs or hedging losses rise. Discuss transaction and translation exposure, local currency operations, reported versus constant currency growth, hedging, operating margins, sensitivity analysis, and why currency effects differ across revenue and cost locations. Question 12. What is the difference between revenue and bookings in a gaming business? Bookings represent customer spending or contracted value, whereas revenue reflects the portion recognized under accounting rules after Sony satisfies its performance obligations. A game sold outright may be recognized relatively quickly, while a subscription or online service can create deferred revenue recognized over the service period. Therefore, bookings can signal demand before revenue appears. I would monitor both metrics and reconcile the difference through deferred revenue, refunds, platform fees, and timing of delivery. Make sure to distinguish customer spending from accounting recognition, explain deferred revenue for subscriptions and digital services, and mention why bookings provide demand insight while revenue follows delivery obligations. Question 13. How would you analyze working capital at Sony? I would analyze receivable days, inventory days, payable days, and deferred revenue relative to sales and cost of goods sold. I would investigate movements by segment because hardware manufacturing, digital subscriptions, and content businesses have very different working capital profiles. I would also account for seasonality around product launches and holidays. A temporary inventory build may support a launch, while persistent growth above demand could signal obsolescence risk and weaker future cash conversion. In your answer, cover receivables, inventory, payables, deferred revenue, days metrics, seasonality, segment differences, cash conversion, and the distinction between operational improvement and temporary balance sheet movements. Question 14. How would you assess an acquisition or investment opportunity for Sony? I would first assess strategic fit, including access to intellectual property, audiences, technology, or distribution. Then I would value the target on a standalone basis, estimate realistic revenue and cost synergies, and model purchase price, financing, integration costs, and downside cases. I would evaluate IRR, payback, earnings impact, and return on invested capital rather than relying only on accretion. Finally, I would challenge assumptions around retention, regulation, rights ownership, and execution capacity. Focus on strategic fit, standalone value, synergies, purchase price, financing, integration risk, accretion or dilution, return thresholds, scenario analysis, and risks involving intellectual property, regulation, and culture. Question 15. What accounting issues are especially relevant to Sony's entertainment businesses? Entertainment accounting requires careful attention to content costs, intellectual property rights, licensing arrangements, and revenue recognition obligations. Costs may be capitalized and amortized based on expected exploitation patterns, while licensing revenue can depend on delivery, usage, or contract periods. I would monitor impairment indicators, changes in expected audience or monetization, and contract liabilities from advance payments. The key analytical discipline is separating sustainable operating performance from timing effects created by content investment and recognition rules. Be sure to discuss intellectual property capitalization, amortization, licensing revenue, content costs, impairment, contract liabilities, performance obligations, and judgment around useful lives and expected monetization. Question 16. How would you analyze Sony's image sensor business? I would track sensor volumes, wafer capacity, utilization, content per smartphone or vehicle, pricing, product mix, gross margin, and customer concentration. Capital expenditure and depreciation are important because the business is capacity-intensive and cyclical. I would distinguish demand-driven inventory from customer destocking, and assess whether technology leadership supports pricing. Forecasting should combine end market volumes with Sony's share, manufacturing constraints, and launch timing rather than assuming semiconductor growth automatically converts into profit. Discuss wafer capacity, utilization, units, content per device, customer concentration, pricing, mix, gross margin, capital expenditure, semiconductor cycles, inventory, and technological differentiation. Question 17. How would you investigate a variance between forecast and actual operating income? I would build a bridge from forecast to actual operating income, separating volume, price, mix, variable costs, fixed costs, foreign exchange, timing, and one-time items. I would then validate each driver against operational data, management commentary, and accounting records. For example, lower profit might reflect fewer console shipments, unfavorable software mix, or higher marketing spend rather than a broad demand problem. I would update the forecast only after identifying the root cause and determining whether it is recurring. While answering, explain a structured bridge using volume, price, mix, costs, foreign exchange, timing, one-offs, and accounting changes, followed by root cause validation and forecast updates. Question 18. What would you do if management's forecast appeared overly optimistic? I would first identify which assumptions drive the optimism, such as market growth, product timing, margin recovery, or currency. I would compare them with historical performance, external data, and segment-level evidence, then build base, upside, and downside cases. I would present the analysis respectfully, explaining the business implications rather than simply rejecting management's view. I would document assumptions, seek clarification, and escalate material concerns through the appropriate review process while keeping the model transparent. Make sure to cover fact-based challenge, independent assumptions, evidence, sensitivity ranges, respectful communication, documentation, escalation, and preserving decision usefulness without becoming unnecessarily confrontational. Question 19. Tell me about a time you used data to influence a decision. In a previous project, I noticed that forecast errors were concentrated in a small group of products. I cleaned the historical sales data, separated seasonal effects from genuine trend changes, and built a driver-based forecast. The analysis showed that the team was using outdated price assumptions rather than demand weakness. I presented the findings with a simple bridge and sensitivity table, which led to revised pricing inputs and materially improved the next forecast cycle. It also strengthened stakeholder confidence in my recommendations. In your answer, use a concise situation task-action result structure, quantify the analysis, explain how you communicated it, and show a measurable business or decision-making impact. Question 20. How would you use Excel to build a reliable financial model? I would separate inputs, calculations, outputs, and supporting schedules, using consistent formatting and clearly labeled assumptions. I would link statements rather than hard code results, include balance checks and cash flow reconciliations, and document source data. Scenario switches and sensitivity tables would make key risks visible. Before sharing, I would test edge cases, trace major formulas, compare outputs with historical results, and review the model independently. A model is useful only when another analyst can understand and audit it. Be sure to mention clear structure, assumptions, formulas, checks, source documentation, scenario controls, sensitivity analysis, error testing, version control, and avoiding hard-coded numbers within calculation areas. Question 21. How would you explain a complex financial result to a non-finance manager? I would start with the conclusion and its business implication, then explain the result through 2 or 3 operational drivers. For example, instead of saying margin declined because of unfavorable mix, I would explain that lower software sales and higher hardware discounts reduced profit by a quantified amount. I would use a simple bridge, distinguish temporary from recurring effects, and invite questions. The objective is not to display technical knowledge, it is to help the manager make a better decision. Focus on leading with the conclusion, translating accounting terms into business drivers, using a concise bridge or visual, quantifying impact, checking understanding, and tailoring detail to the audience. Question 22. How would you evaluate a new PlayStation product launch financially? I would model units sold, average selling price, software attach rate, digital spending, subscription conversion, manufacturing cost, marketing investment, and launch timing. I would also consider cannibalization of existing products, inventory requirements, and the product's effect on lifetime ecosystem value. I would calculate contribution margin and break even under base, upside, and downside cases, then distinguish first-year profitability from strategic benefits. The decision should reflect both immediate economics and recurring engagement across Sony's platform. Discuss unit assumptions, price, attach rates, subscription conversion, manufacturing costs, marketing, cannibalization, inventory, launch timing, break-even, scenarios, and longer-term ecosystem value. Question 23. How would interest rates affect Sony's businesses and valuation? Higher rates generally increase Sony's cost of debt and WACC, reducing the present value of long-term cash flows. They may also pressure consumer spending on hardware and entertainment, while affecting investment returns, funding costs, and product pricing in financial services. The impact is not uniform. Cash-rich operations may earn more interest, but growth valuations are often more sensitive. I would model direct financing effects separately from demand and currency effects, then assess the combined impact by segment. In your answer, cover discount rates, borrowing costs, consumer demand, exchange rates, financial services earnings, cash yields, duration-sensitive valuations, and the difference between direct and indirect effects. Question 24. What financial risks would you monitor at Sony? I would monitor foreign exchange, product cycle volatility, semiconductor supply, inventory obsolescence, customer concentration, content underperformance, and intellectual property disputes. Sony also faces cybersecurity, privacy, regulatory, credit, liquidity, and financial reporting risks. I would rank risks by probability and financial impact, assign measurable indicators, and connect each one to a mitigation plan. For example, inventory days can flag demand risk, while scenario analysis can quantify how a major product delay affects revenue, cash flow, and covenant headroom. Be sure to mention foreign exchange, product cycle risk, semiconductor supply, intellectual property concentration, content performance, cybersecurity, regulation, credit risk, liquidity, and controls over reporting data. Question 25. How would you respond if you discovered an error in a report just before a deadline? I would verify the error quickly, determine which outputs and decisions it affects, and notify the responsible manager immediately rather than hiding it. I would correct the underlying source or formula, rerun the relevant checks, and clearly communicate the change and any remaining uncertainty. If the deadline made a full rebuild impossible, I would provide a corrected estimate with transparent limitations. Afterward, I would document the root cause and add a control, such as an automated reconciliation or review checkpoint. While answering, emphasize verifying the issue, assessing materiality, notifying the owner promptly, correcting source data and outputs, documenting the change, communicating impact, and improving controls afterward. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.